when there's excess and there's waste and there's no responsibility and accountability, I don't care whether you're a Democrat, a Libertarian, or a Republican, the bottom line is we can all agree that the political system is broke because you don't, in business, go 23 trillion in debt. You go to jail. They don't go to jail. They walk away with $10 million when they leave office. That's crap. I'm not going to support all of that. People that are behind doors that never interact with the public and the government, I would kill 50% of those jobs in 12 months. You know how much money would get entered in the economy? There's this whole notion out there of accumulating wealth. And accumulation is a pretty slow, tedious process. And it's where a lot of the myths and misinformation come from. Like accumulation is setting money aside, waiting for compound interest to kick in, and then, hopefully 30 years from now, people are okay, but they're not. And it's kind of this invest early, often, and always, buy, hold, and pray. You're in it for the long haul notion. And how long does it take most people to go scrimp and save money to kick off cash flow 10, 20, 30 years from now? So what I'd rather do is let's spend 20, 30 minutes right now giving you a framework to save a boatload of tax. Because that's an immediate return, it's a guaranteed return, it adds right to your bottom line. So I just want to give you a framework that once you know this framework, I think it can save you a lot of money. And so the first part, it isn't revolutionary, but it's probably the hardest piece to do. The second part, I'll give you some additional insight. You might be managing the second part really well. The third part is where the major movements come. So there's three main tax parts we're going to cover. Before we do, I'm just going to say the two places where people make the biggest tax mistakes that are out there. The first tax mistake people make is they spend $1 to save 37 cents. I call that the tax tail wagging the dog. I just had someone tell me they bought a 6,000-pound vehicle, a Bentley, by the way, SUV, because they could write it off through Section 179. I'm like, well, did you want the Bentley? Because it's really expensive, and if you didn't want it, you just got screwed tax-wise. Like, yeah, you saved some, but you spent a lot of money. Like, forevermore, I want to show you today tax arbitrage, where if you spend $1 to save tax, you're getting more than $1 of real credit and savings. Should be more like 2 to 1 or something like that. So I'll give you concepts in tax arbitrage. The second big mistake people make is deferring tax. Deferring tax is a major mistake. If we go back to 1944 all the way to 1981, the tax bracket was above 50% during that entire time. So what happens if you take a 37.5% tax rate and you defer into a rate that's like 60 or 70%, or at the top it was at 94%? Well, what happens in that situation is you never want to take the money out, because if you hate paying tax today, I'm here to tell you, you're going to hate paying it more in the future. See, because what I found is with age comes bitterness sometimes, right? Like my grandma. When I'm like, Grandma, you're 70 and a half, you have to take this money out of your 401k, otherwise that required minimum distribution will give you tax and penalty. And it was the first time I heard her say the F word, to be honest. But not the last. Once that dam broke, But see, the committee kind of goes away. So like if you hate paying tax, deferring it isn't necessarily saving it. It's delaying it. And if you don't have a clear exit strategy or you don't have offsets, then what happens is it might as well be a 100% tax rate, because if you don't want to get to it and pay the tax on it, what good was it anyway? It's never being utilized. It's one of the worst things in a retirement plan to pass on to the next generation. You can do a stretch IRA, which means no one ever gets the money. I mean, it's like, yeah, you can keep deferring and delaying, but eventually there's going to be that day of reckoning, and when it is, well, you hope it doesn't all get taxed in 1 year, because it might be a larger sum of money, or what it does to the other assets. So if you do have those plans, there's things that you can do, like a rescue strategy. Like if you have a retirement plan, everyone, no matter how much money you make, how much wealth you do have the right to convert that to a Roth. When you convert it to a Roth, if you can get a valuation on the assets to be less than what it's actually worth, like structured settlements do, then you're going to pay less tax, and at least you're now in a tax-free environment. So if taxes go up, you're not subject to that higher tax. So that would be one example of something you can do. What I did is, when I realized these things weren't great, here's how I recognized they weren't amazing. If you were to start a financial institution today, what do you want from people? You want their money, right? How often? Yeah, all the time. How long do you want to hold on to it for? As long, forever. And then how much do you want to give them back when they want to withdraw? Hence the retirement plan. It follows those 4 rules. Like, how awesome for a financial institution, because not only do they get to take fees on your money, they take fees on the government's money. There's restrictions to when you get to that money. There's automatic deposits now, and if you're an employer, typically your employees are automatically opted in with the new rules unless you choose differently, and if you don't, that's usually the default. So awesome, they get to put money in that even if they have double-digit interest rates with their other, credit cards and stuff. So I don't think deferral and delaying is the best thing. It typically doesn't work in most areas of life. The only time I found deferral and delaying to be really good is you should always file an extension on your taxes. Because if you file an extension, you've just bought more time for your amendments. So one of the things we're investigating right now, we've been working with this firm for a few months, and I'm now at the phase where I'm giving my taxes to them, but they go back and they look for everything from R&D credits and domestic production credits to continuing education credits. There's over 900 different rebates and incentives that the government gives, and they just got a dentist $110,000 back, a chiropractor $30,000 back. So now I'm going to see, I'm not a doctor, which disappoints my kids, to be honest. I always let them know how much I help doctors, but they don't care. They just would rather me help them at home. I'm like, you shouldn't, yeah, anyway, just a side note there. But that's an example of, like, you can go back, but if you file an extension, you have all the way till October, if that's what you filed your extension to go back 3 years. If you paid on time and filed in April, you're already chopped off a year. So even if you paid in full, everything's organized, that's one time it makes sense to procrastinate. All right, let's talk about these 3 tax buckets. The first bucket is the team, and it's what I call the 3 by 3 by 3 strategy, okay? Now, a tax team begins with record keeping. So you gotta have some type of bookkeeper, controller, or CFO, because timely data is gonna save you money. When you have that information, so you can make decisions along the way, that's gonna be super useful. So the first one would be just some type of bookkeeping, right? The second one is a tax strategist. A tax strategist might be a CPA, but a CPA might not be a tax strategist. Some CPAs, their job is to file your taxes, not to talk to you about how to maximize tax deductions. And if you want to know whether they're a tax strategist or not, tax strategists don't use the word like, hey, my number one job is to keep you away from an audit. Hey, I'm really conservative. People that say that are letting you know you're overpaying on your taxes, and they've given the excuse up front so you won't be mad at them. Like, why be conservative if you're taking full advantage of the law within the law? Like, where it's not conservative, this would be a dumb idea, is not to report your income. That's what gets you into trouble in the US, not reporting your income. Another thing that gets you into trouble, if you take a deduction that's not allowed that was more than 20% of your overall tax deductions, there could be a 25% penalty. But there's a lot of people that are completely afraid of audits, but the IRS intends to audit you at least once during your lifetime. I look at an audit as market research for me. I personally do. And then for a lot of our clients, I look at it as like a 33% chance we're going to save more money and almost a 0% chance they're going to owe more. So if you're a sole proprietor, you have a 400% higher chance of audit, so incorporating helps you out. If you're an LLC or an S Corp, you're less likely to get the best auditors. Those are usually reserved for C corporations. So just a few things to kind of note. But if you did get audited, if you're well organized, because you have good bookkeeping, and you got those documents, and that you treat them extraordinarily well, and not you, but your tax team, and you never go to your audit because you're not the CPA, let your tax team handle it, because if they ask you a question you don't know, that's a red flag. If they ask your tax team, it's not a red flag. The tax person gets to say, I'm gonna have to check with David on that, and I'll get back to you. And by the way, that tax person has a direct line to the IRS, and you don't. So you just don't have to stress and worry, and there's plenty of opportunity to get money back in an audit, because now you can get really aggressive when they're sitting across from you, and they'll either leave quickly or you save a little bit of money. The third piece is a tax attorney, or at minimum a corporate attorney. Like, this is where most of the value of saving tax comes from. And because we have a lot of people in here, I'll actually just throw in, if you're in real estate, you might want a cost segregation engineer if you own commercial property, because you can accelerate your depreciation, and they can do a study for that. So that might be one to the team. But okay, so we've got the 3 people here. your bookkeeper, your tax strategist, your tax attorney, and then every 3 months, you do a phone call with them. That phone call could be as little as 20 minutes in length or as long as 60 minutes in length. Your job is to be an entrepreneur on that phone call. Realize you're not talking to the IRS, you're not taking any action from that call, so it's your time to brainstorm. I have my call coming up in June. The first question I'm going to ask is, I just bought a Can-Am, those twin turbo, like go-kart, souped up things. Can I write that off? Now, they're going to say no. Then I'm going to say, but we just filmed it, and it's going to be at the beginning of every podcast. Every podcast guest gets to go for a ride. Like, I'm going to get some percentage of that written off. It won't be completely zero. I know it's not 100%, but I always start with just brainstorming. Hey, I'm going to Italy. Can I write off the trip? They go, no. I'm like, but I'm hosting a mastermind one of the days. This number of clients are coming to visit. We're going to go to where my great-grandfather's from with the drone, and we're going to get footage there. We're going to, by the end of the call, it was 55% of the trip I was able to write off. Because one, I had to do a corporate compliance meeting for every entity that I owned. So those mills, part of the travel, right? So that's your job, is just to ask questions. And if you say, can I write this off? And they say no, say in what case or what type of business could someone write this off? And that might give you some insight. Or you ask them questions like, what's the coolest tax strategy you've learned about or implemented since last time we talked? Could that apply to me? Their job is more to navigate the tax code and stay within the law. My job is to be an entrepreneur and to think like a strategist. So I'm just asking them a boatload of questions. We're actually recording my calls now and giving them to the people that work with us so they can just hear exactly how I do it. It'll be entertaining. I will give you that. I just ask the most ridiculous things on that, and then I go, no, I'm just kidding. We're not trying to write that off. But it's still fun to play with these guys. They don't always have the full sense of humor that they should. So 3 people that's on your team, you meet every 3 months, and then every 3 years you get a different set of eyes, and you go look back and see if you've missed something. So you can go back I mentioned R&D. So if you've done any software development, modified a CRM, done any technology that had to do with you used employees inside the United States, there's major credits from Section 199. Or domestic production, did you do research? Like now I'm doing research, right, with BYU University, which will just make even more people Google Garrett Gunderson LDS. That's the second most Googled thing. People want to know if I'm LDS. I look like Jesus, so that's confusing. Or at least the Utah version of Jesus, not the Middle East one. But ultimately, BYU is the one that stepped up. So, I'm not Mormon. Just so you don't have to Google it. I don't want that becoming the number one Google. So, as we have these meetings every 3 years, you can look back and amend the returns if something was missed. Domestic production is looking and finding out, did I do research and that research lead to a product that created income? I can take a certain percentage of net revenue in credits above and beyond the cost or the hard cost. This becomes incentives that you can go back. So that would be one way of looking back, or maybe just something was missed. We just went through looking at amending someone's returns that became our client recently. They were paying 3.2% tax on every dollar of income that they had that wasn't required to be paid on. So it wasn't that we were that genius, but that was hundreds of thousands of dollars from a mistake. By getting a different set of eyes, they're able to go back and amend returns. So meet every quarter, look back every 3 years. What I tell these people when they go back and look every 3 years, every 3 years, I just say, I'll pay your fee. If you find something, I'll double it. And if you find something major, you'll either be added to the team or replace someone on the team. And by the way, that means you're going to get a lot more business than just me because of the business we're in. So that's what I do on that side. Okay, so that's the team. Kind of difficult to find these players sometimes. At Wealth Factory, we have them. We're constantly interviewing accountants. It's like a regular occurrence for us because they hit capacity issues, or they're not good at building a business, if they're good at tax strategy or whatever that might be. All right, the second piece is deductions. So for deductions, I just have 2 main rules. Number 1, you ask anytime you make a purchase, does this relate to my business, or how does this relate to my business? And number 2, you document it. Now, you might take things like my Can-Am that I've now put down on my list. I'm not actually filing taxes and writing that off. It's on my list because I'm going to ask on my quarterly meeting, can I write this off? Some people go like, I don't think this is something I can write off, so they don't record it, and then it never has a chance. I'm going to have it have a chance until they tell me no, right? So number one, document it, right? Number one, just make sure to ask how it relates to the business, and number two, document it, and then just find some of the cool nuances in the tax deduction world. Anyone in here know the Augusta rule? Did I talk about it last time? So the Augusta rule is awesome because you can rent out your home 14 days a year to your business. You can write that off. Just a funny story on this. So we were going to do the Augusta rule. David is at one of our events. And so I had hired some cooks. We were going to have a dinner at my house. I was renting out the house to the business. That's a tax deduction for the business. It's not taxable to me if it's 14 days or less. Well, at the same time, my wife had ordered something from this restoration hardware store that apparently white glove service means they drop the armoire right in the hallway when you open the door. So David and 5 other people, including Aaron that's with me, we had to get that thing up the stairs. I'm like, we're risking everybody's health getting this heavy thing up there. But we Augusta ruled that, so we got to write it off, right? Hosted that, but I don't have to claim that as personal income. Or I pay my kids $12,000 a year each because you can pay them $12,000 a year as long as you're actually having them do work worth $12,000 a year, and that's tax-free if they're 18 and under to them, but it's tax deductible to you. So those are some examples of tax deductions. I mean, there's hundreds of them out there, and there's a lot of ones that people miss simply because they just didn't document it and they didn't have these conversations with their tax team. When you're talking to your tax team between January and April, it's pretty worthless. When you're meeting with them right now in June, that's going to be a profound call. Number one, they can find out that I'm up from last year, so we can start to address that. There's no surprises. We can start to navigate things. Like, we'll just talk. Hey, does it make sense now to do a NING, a grantor defective income trust for my clients outside of Utah, which is almost everyone, so I don't have to pay Utah state tax? We decided not to do it last year. Well, June's a good time to talk about that because it's going to take 3, 4, 5 months to implement. And if I talk to them about it in December, the answer is going to be like, yeah, it might have been a good idea, but it's too late, right? So that's why every 3 months. All right, so the deductions being the second part. And then the third part, this is the big part. I'll go ahead and flip the page here. This is where the biggest savings are, and this is where the attorneys come in. It's reclassification. Reclassify your income. There's 4 ways to do it. The first way is we want to turn active income into passive income. So there's a few ways you can turn active income into passive income. Reasonable salary test. You can set up an S corporation, pay yourself a reasonable salary, which isn't what you're worth, but what someone else would do the job for, and pay the rest in distributions. Now, make sure you use the reasonable salary test. Some people go, oh yeah, they're a solopreneur. They have no employees. They're like, I'm going to pay myself 30% salary, 70% dividends, and guess what? If you get audited, they're going to say, what? This doesn't make any sense. You're the only employee. But someone like Warren Buffett, who's not, he's not actually showing up to the companies that he buys. He's implementing that with, other people going and do that. He could take almost no salary or take a lower salary than even his secretary and take the rest in, stock or distributions, and therefore is going to have more passive income, and that passive income will save you as high as 15.3% or as little as 3.2 once you've maxed out FICA and FUTA. And even after 250 grand, it saves you an extra 3.7 on top of the 3.2 because Obama had initiated a success tax that came in at that point. So you're saving anywhere from 3.2 to 15.3 just in how you take your income. Maybe it's a building that you office in and you have an LLC that owns that, and then you just charge yourself the highest reasonable rent for that, so the income's coming in through there, through 1099 instead of W-2. You're just reclassifying how the income comes to you to save on tax. The second thing is anytime you can move from ordinary income to capital gain. So let's say you do business internationally. If you have international customers, you can set up an international sales corporation, and if those customers pay you to your international sales corporation, it's a capital gain. Capital gain might save you 15% in tax, right? Or let's say that you have a substantial business, and there's substantial risk with that business. Well, I have a captive insurance agency, so I have my own insurance company that I put cash into pre-tax. If I don't have an insurance claim, I can take that money out capital gain instead of ordinary income. That's an 831B. Now you have to do those right because number one, if you set those up, you are more likely to get audited if you own a captive than if you don't. So it does increase your likelihood of audit. And tons of people abuse those. They put the wrong type of assets in it. They invest outside of the spectrum that they're allowed, and those are the ones that get in trouble. And there's plenty of people that do it right, and they don't have problems. So they do have a bit of an interesting reputation because there was a time where the government was thinking about shutting them down. But since that time, they went from 1.1 million that you could put into it to 2.3. So we've actually seen, there's ways to do it right, which means a feasibility study and the right companies. I had a client call me and say he was going to set one up for $5,000 through an Indian reservation company, and I was like, okay, come on. Like $5,000, that would be nice to save the money, but sometimes saving money costs you a bundle, right? Sometimes the most expensive advice is free advice, so I talked him out of it. But those are just a few examples of moving from ordinary income to capital gains. And look, everyone here should get intimately familiar with Section 199A. 199A changed the game on how we can pay ourselves and get that pass-through deduction. Now, originally, when Trump was talking about it, it sounded like anyone with a corporation was going to move to a 15% tax rate. But then they came down to two equations, and the greater or lesser than this, and I would have to take a whole 2 hours just to explain the damn thing. But the reality is it saved me a boatload of cash last year. I actually increased salaries for myself and some of my employees and paid a little bit less in distribution because it gave us that pass-through deduction. So you want to learn about 199A. If you don't know about it, you're overpaying tax. All right. Third, I like this one, tax-free. Very exclusive to real estate owners and business owners. You get this tax-free opportunity. One of my favorite things is a charitable remainder trust. We just had a client who's selling his business. Fortunately, we got a hold of him early enough before he had a letter of intent and the business was being sold. It's due to close next week. And so his savings doing a charitable trust is $2.5 million. Plus he gets a tax deduction, which we're still figuring out what the assessment is, but it's somewhere around $900,000 to $1.1 million is the range that he's in. He'll be able to have 5% and 50% to 50% is like the high end, depending on underlying assets he can invest inside of this charitable trust. When he dies, the charity keeps whatever's left over, but he gets to live off that income for the rest of his life, and the full amount with the tax deduction he can take that year plus 5 years later against half of his adjusted gross income. It's called the charitable remainder trust. There's a bit more to it than that, but I just want to give you a sense of that when you understand that, you can do that with real estate. So it's pretty cool because if you do it right, you can actually give money away, spend more money during your lifetime, and if you use the Rockefeller method, replenish that wealth tax-free back to your heirs because of the insurance. So it's a pretty cool concept. So that's just one example on the tax-free side. And then fourth is tax arbitrage. So tax arbitrage is what I started with here. I mentioned it. And so tax arbitrage looks like this. Who in here knows about historical easements? Historical easements are, harder to come by, but amazing if you can. So since there's a lot going on in Dallas and Austin, because I know we got some people from Austin here, like development rights have gone up massively in value. And so what a lot of these cities value is the historical preservation of what already exists. I'm in a historical building in Salt Lake called the Hardware Building, built in 1902. And a historical easement allows you to donate the historical facade. The historical facade means that you cannot tear that building down and build a bigger building. So you're forfeiting the right to be able to redevelop it, but what you can do is still rent that out, cash flow that, but the Forest Service of all places deems whether it's worthy or not as a historical easement, and you can get major tax advantages. The best I've seen, the tax advantage paid for the building. And then they still got to rent it out. So it's harder to find historical easements, but if you do, that's tax arbitrage. You're actually getting the asset, and you're getting this major tax advantage. It varies based upon how valuable the development is, how valuable the property is. If you go to Austin, they're just building so many things, not highways, mind you, but just buildings, because who needs, traffic's fun. So, but it's more valuable there because it is highly, but if you go to my hometown of East Carbon, Utah, nobody's gonna pay you anything for a historical easement because nobody wants whatever's left there and buildings. So it really depends on the city's value and how much development's going on. I actually own 10 acres on a mountain not too far from here, and I was thinking about selling it, and then for a while I was like, well, maybe I'll do a conservation easement. So we had a client in September, had a bunch of land in West Texas, and he hated the land. He's like, there's nothing there. He just couldn't sell it for what he wanted to get for it. And so we just did an assessment. We're like, hey, is there sand on the land? He's like, yes. We're like, oh, well, sand is required for fracking. So what if we just send out an appraiser and we figure out if you were to develop that land, what it would be worth if you sold that sand as now a fracking opportunity. We're not going to ask you to do it. We're just going to find out what it's worth. And what it was worth was a 6.5 to 1 tax deduction, which meant he got back, that's the deduction. So looking at a credit, it's still like 2.5 to 1. For every dollar he spent on the land, he got $2.50 in tax credits through being a conservation easement. He'll never sell the land. It will never be developed, but he got a major tax advantage greater than what he paid. So there's syndicates that do that. I just want to warn you on those. I did one for the first time last year. If they don't do it right, it could go bad in an audit. What I mean by that is when you're now putting money in and you have unrelated investors, right? And you go in and if they don't do a full vote and say, do you want to sell this land, develop this land, or donate the rights to the development? Well, ours, it was 82% wanted to donate the rights, right? And then they have to do some other specific things, like we did multiple appraisals to determine what the value was, and then you got to pick which appraisal you want to use. And so if they don't do all those things properly, one person getting audited and didn't do it right will trigger an audit for pretty much anyone else in that easement. But if you already own the land and you never want to develop it, like I have a client that has a place in just outside of Colorado Springs, Colorado, and he's got like 500 some acres. It's a big ranch, but he's got 31 acre lots on it. I said, are you ever going to develop it? He said, no. And I said, let's do a conservation easement on those. This can get you a major tax deduction, and you never plan on developing it anyway, so might as well get that benefit today. That's a conservation easement. Okay, so historical easement, conservation easement, those are two examples. The thing that I did first, I did this in 2006 before I even called it tax arbitrage, was I bought a huge art collection. I bought from 2 artists a ton of their art, but I signed an agreement that I wasn't going to sell it on the open market, so they sold it to me for 25 cents on the dollar of what the actual appraised value was. Now, after I held that for 3 years, it went from book value, which is what I paid, to appraised value, which is what it was worth, and then I donated it to museums, and that donation got me back $2 for every dollar I spent. Okay, so that's tax arbitrage. I look at tax arbitrage as kind of your last resort, or if you can add it on to the deals that you're already doing. But why would you ever go buy a vehicle that you don't want to get 37 cents on the dollar when you could do this and get $2 back for every dollar you spend? So, now if you want the vehicle, just buy the vehicle. That's cool. I bought a truck last year, and I'm from a small town, so it means a lot to me. Now, the people in a small town don't consider it a truck because it's a Raptor. And my wealthy friends just think I'm white trash, so I don't really fit in anywhere, but I love my truck anyway. So, look, this is just one of the 4 areas of efficiency. So we began with mindset. We just talked about playing not to lose. I don't think there's a lot of people in this room in the playing not to lose segment. I think there's more people in the playing to win. But at what cost? Have you defined success for yourself? Is the juice worth the squeeze? Like, what about quality of life at the forefront? And how can you be more abundant because you've really taken care of self-care and yourself and enjoying life along the way, building a life you love. The second thing was money. We talked about 3 main segments of money. The first one being more efficient, which was the IRS, which I gave you the framework for. The second one being interest. The third one being investments. And the fourth one being insurance. We have, that's a couple days to go through all of that. Then we talked about this economic independence framework. The economic independence framework is, first, recover cash, plug the leaks. Second, engineer wealth. Figure out what your economic independence number is. Reverse engineer what's the fastest way to get there. For some, it's paying off loans. For others, it's buying real estate. For others, it's growing their business. The third thing is you become a cash flow investor. Everything that's not creating cash flow for you, turn the cash flow button on, right? Have that start to present cash flow rather than accumulate. The fourth thing is you scale your business. Scale business revenue, whether that's cycle of creation, whether that's investing in the right people in your business, whether that's adding more value to existing customers or reaching more. But scaling business is the unparalleled advantage of economic independence. And the fifth thing to economic independence is make it count. Enjoy life along the way. You are your greatest asset, so you invest in yourself. You take care of yourself along the way so you have plenty to give and you're not exhausted. And so make it count is really living that legacy. So recover cash, engineer wealth, accelerate investment income, scale business revenue, and make it count. That's how you get economic independence. It takes 3 to 7 years. It doesn't take 30 years. Then the next part, as I said, how about making money on the buy? Becoming a cash flow investor, buying when everybody else is losing so that you're making money on the buy. Ted Turner was masterful at that, is masterful at that. He owns more land in the US than I think anyone, definitely in Montana, but he didn't buy it when everybody else was in the craze of buying. He bought it when everybody else was liquidating because they were in a cash crunch. That's when he bought CNN. He actually sold his signage company, and when they hit a cash crunch, bought it back for less than he sold it for. Like, that's making money on the buy. You can read an article in the New York Times written by Malcolm Gladwell that features him called Predatory Investing. The third thing was cycle of creation. Taking and profiting from ideas, using your market, using the very end users to be the people that fund what you're up to so you're not left with loans and all the time it takes to go get that. So that's pre-selling. And the fourth piece we spent a lot of time in, which was legacy, which I won't use your name because I have permission, but someone came up and said, hey, here's what we're gonna do for our family on legacy. We're gonna just show your video. And that way the idea is coming from you, Garrett, not from us. Dude, this is exactly how I do things with my wife. I go, all right, if I tell her, it's gonna be a stupid idea. But who do I know that can tell her that that's gonna be brilliant, right? And I just get them to tell her. And then, like once I had a client that I said, hey, let's go hear him speak. And they're like sharing the content that I was helping them write a book with that I gave. And she's like, are you listening to this? I'm like, yeah. Are you? You know? She's like, this is brilliant. I'm like, yep. I thought so too. So that's the framework. Now let's open it up to Q&A. So hopefully I've given you some good philosophical framework, but then I've also given you a really practical framework within your tax structure.
We got the catch box with Jordan. Back here to Randy.
You've talked a lot about all the different strategies, and you talked about moving from the scarcity to abundance and excess. Where are the thresholds? When you start looking at some of these things, you need X amount of cash flow before these types of things make sense. You need X amount of net worth before those types of things make sense. Could you give us some framework on that?
Yeah, so there's a few thresholds, and I'll go through several of them here. So the first one is, the first simplest, most important threshold is rudimentary, but it's you gotta pay yourself first. So every time you're taking personal income, you're taking 18% off the top, you're setting it aside into what I call a wealth capture account, which is just a money market, savings account, checking account. It's just separating it so it's not commingled with your business funds, it's not commingled with your personal funds. And you've got to get that to 6 months liquidity on personal expenses. That's a big benchmark, right? When it's at 6 months, I actually take and put all of that into cash value insurance now on that 18%, not into that account. Now 18% I can break down why if we need to later. It's 3% by 3% by 3% because of taxes, inflation, planned obsolescence, propensity to consume, technological change. There's a reason behind it. But once you have that, now your main focus is economic independence. So the basic economic independence of just covering your expenses through cash flow. There's 2 ways to do it. One is with your assets. The second is with business. But with business, I'm talking entrepreneurial income. So I have a lot of entrepreneurial income because I create content for organizations that pay me a licensing fee. And they pay me that every time someone uses it and month by month, so that creates a recurring revenue. I filmed it once, I'm still moderately involved, but I'm not daily involved in it. I can go to Italy for 2 months and still have income come in from that. If that income stops, that's not entrepreneurial income, that's just active income, right? So you want to get that to a 1-to-1 ratio, ideally a 2-to-1 ratio. That would even be the next benchmark. The benchmark after that is when you have $1 million of net income or $2 million of liquid net worth or $7 million of total net worth. So 1 million net income, 2 million liquid net worth, meaning you can get to that money within a week, or 7 million, it can be tied up in businesses. Now you are open to a portfolio bank. Now you can work with private banks and portfolio banks, and you're gonna have a different set of rules around lending, access to money, building out private structures. eliminating fees. So that becomes another benchmark. As you start to get into these concepts, you'll hear, I think later this afternoon, that's when asset protection becomes even more essential. Now, I look at asset protection in multiple dimensions. Insurance as one line of defense, corporate structure as another line of defense, domestic asset protection trust as another line of defense, and liquidity as yet another line of defense, right? Captive insurance. So it's like it becomes more comprehensive as time goes on, and you might just start with a basic corporate structure, but then you might expand and have a holding company with multiple corporations as you build bigger net worth, right? So that just becomes something that I think that you have to look at least annually. Like I just always have my estate planning meetings already on the books to meet once a year so I don't blow it off or forget about it, because I've just met people with estate plans, they've got 3 kids since the last time they did an estate plan. I'm like, what good does that do? Or they have an estate plan and nothing's deeded into it, so I'm like, that doesn't really help. So I think that just creating automatic habits and rhythms become critically important as well. But I will say this on the accounting side. Like our hardest thing that we do at Wealth Factory is vet and find accountants. I think we have 5 firms now that we work with. And a local accountant might be really useful from a bookkeeping standpoint, but with all the technology that's out there today, we don't really emphasize that. We're looking for firms that know all 50 states or have, partners or strategic alliances in those states. But like, look, if you're in California, then we need a California-based one, right? If you're in New York, we need it. But other states, it's pretty easy to navigate overall. And I think you just look for the very best that there is to offer. I typically don't look in San Francisco, Chicago, or New York because you're going to overpay for the same quality. So I look for who are the people out there that wanted to live somewhere else that have a national presence. And look, we're just constantly interviewing, having them read books. Like I fight with accountants more than anyone because now I'm just really clear. Like I get on the phone with them. The first thing I say is, do you recommend retirement plans? And if you do, we might as well just start there because it might be the end of the conversation. And if they go, well, if they go in these situations, like, okay, I could see where that might make sense, but like I just have saved a lot of time doing that. We still can't find good Canadian accountants that at least I trust. Some of the ones we found, I'm like, dude, I don't know if our guys are going to go to jail if they take these advice. It sounds pretty cool, but I don't know how to navigate it. So, that's what we do. So if you do a strategy session, we find those accounting firms.
Thank you.
Yeah.
So I'm very interested in the scaling up of a business. But if you have a business that, in order to function properly and at its peak, needs to be regionalized, would you think about maybe franchising in order to scale it up and just get the franchise fees?
You got to navigate the franchise rules. And so that's a question beyond my expertise of what those rules are and how that works. Licensing was infinitely easier for me than franchising, but it might not be the right business model for you because I'm primarily at intellectual property and content, less brick and mortar and systems and processes. So, I could give you advice, but it wouldn't be the best advice unless we had an attorney present to say what those rules are. Okay. I don't want to, Gunderson said. Turns out you can't do it that way. Yeah, he can address that. So, see, I'll defer to the attorneys. I'll let the, yeah.
Question. This is your chance. I got a question for you.
Yeah.
I'll just go to someone else here. Thanks, sir. So your 2 boys don't know at the moment where to go with their formal education. It's kind of up to them, but it's in the Constitution. You discuss it. Let's say one of them decides they want to go to Harvard. You'll have some discussions. How will that be funded?
That's been an interesting conversation because, as we've had parent-teacher conferences and they bring up grades for college, I say, well, they have to get, if they really want to go to college, fine. But my wife's a school teacher. She's a little bit more pro-college than I am, but I make no bones about it. I'm like, from a social aspect, it's pretty awesome, but there's a lot of stuff that will be, if you tell me you're going to major in X, Y, or Z, college is going to be a waste of time. So let's say that he does go to Harvard because he does have this high IQ. I do feel like the relationship capital at Harvard is pretty substantial, even better than whatever he's going to learn in a lot of cases. And so I will not pay for it outright, but I would supplement it, and I would potentially be the lender at a much better term than what the government is right now. Because now the government's saying, hey, a lot of times they want a co-signer now, and they're now going after that estate, even if the person dies. Like, imagine it's just, I hate it, right? Like, I think that colleges are 4 times more expensive because of student loans. Yeah, just like hospitals are 10 times more expensive because of insurance. So I just, if you really want to do that, that's fine. But I'm really going to see how we do with these businesses when they turn 16. If I can find something they really enjoy, which they're already having amazing ideas. Execution will be a different thing, but we'll see. Here's the bottom line. The government's $23 trillion in debt. $23 trillion. If any of your businesses were deep in debt and you told me you were going to make less money next year, I would call that insolvent, irresponsible, lack of stewardship, and yet the government is still willing to say on one side that they're going to lower taxes. How? Only by destroying our monetary system. That's it. So they're basically saying, we'll inflate our way out of this, essentially, right? Well, here's my biggest concern. 23 trillion is a big number. It's so big that if you Google how long it takes to count to a trillion, it's like 37,000 years. It's just stupid. It's like not even real, right? We're okay right now because interest rates are low. We can finance it on the backs of people. But if we raise interest rates, how are we going to pay for 23 trillion? How does the government make money? Taxation. We wouldn't believe a single business out there that's saying, we're just going to make less next year. We're going to scale it back. We're going to do less. We're going to, but we got your best interest in heart. You're like, what do you mean? Like the narrative's wrong. And then you've got other people saying, we should go to 70% tax. Okay, 70% tax? That's asinine. Like, first off, I wouldn't mind paying tax if they went through the 4 eyes of efficiency with the government and said, we're going to be more accountable. We're going to talk about where these dollars are going. We're not going to let this whole notion of people plan their budget based upon what they spent last year, even if they didn't need it, so they don't lose it the next year. And you know what? No more invading Social Security. No more just stealing the money that doesn't now exist. And it's just time to be, big boys and girls and say, hey, if you're not on Social Security now, you don't get it. I'm sorry. There's no money there. We got to stop funding things by robbing other people. That's the bottom line. There's good social programs in there. There's good intentions. But good intentions with poor management still equals bankruptcy. They will raise taxes. They have to. They either raise it or they go away. So taxes will go up. Now that we're inspired, we should go to lunch. The good news is I don't worry about taxes going up as much because I just have a lot of strategy. I had a strategy that was so exciting. I'd been working on it for 5 years. I was going to get a take it in 2018. And that strategy was putting so much of my income into my intellectual property company. Because you know how you can depreciate real estate for tax purposes? Guess what depreciates a lot faster than real estate? Intellectual property. But the new Trump tax plan said you can no longer depreciate intellectual property as a standard depreciation. It moves to a capital loss, and it destroyed my entire strategy. But at the same time, I was meeting with my team on a quarterly basis, and 199A was phenomenal for me. And I had my captive, and I had, that's why the conservation easement wasn't something I wanted to do. It was something that was a plan B when they took the intellectual property opportunity away from me. Your job is to open as many doors as possible for tax advantages and opportunities and go through the doors that make sense year by year, but never relying on one of those doors being open as your only way to get there, right? And so I'm asking the questions most people don't ask. I'm challenging the thinking processes. I'm seeing what our clients are doing. We're doing surveys when I'm going out and speaking, looking at how many of those people are overpaying tax, what they haven't done, how often they meet with people. Like, I feel like I dedicate more of my life and time and thoughts to tax than almost anything. Fortunately, I get to spend a lot of it in legacy, but I just feel like it's our responsibility to minimize our tax legally. Because if we don't, we're just creating really bad habits. Like if I think about my business in 2007, I made stupid mistakes. Why? Too much cash in the account. We had an amazing year that year, so I'm like, oh, you know what we need? We need speakers hanging from the ceiling that were $40,000 for a financial firm. What? We didn't need those. We need bamboo floors. Like, I just started to spend money on stupid stuff because we just got irresponsible. And then all of a sudden, when things tightened, we got responsible, resourceful, and in 2010, we had a skyrocketing amount of growth over anything before because we actually become better at what we do. When there's excess and there's waste and there's no responsibility and accountability, I don't care whether you're a Democrat, a Libertarian, or a Republican, the bottom line is we can all agree that the political system is broke because you don't, in business, go $23 trillion in debt. You go to jail. They don't go to jail. They walk away with $10 million when they leave office. That's crap. I'm not going to support all of that. But you know what? I do like supporting the policemen, the firemen. I do like supporting that there's certain things out there that are absolutely great, but I don't like supporting, like, I got asked, I spoke at a university recently, which is dangerous to let me speak at these places.
I'm surprised they let you in.
I donate money to entrepreneurial cause inside of there to try to revive this thing. But they said, if you were president, what would you do? And I'm like, well, not that I could really do this as president, but people that are behind doors that never interact with the public and the government, I would kill 50% of those jobs in 12 months. You know how much money would get entered in the economy? You know how many conversations I have with people that are going, I hate my job. And I'm like, what do you do? They're like, well, I work, doing X, Y, and Z for the government because it was a safe, secure job. And not that I was inviting what happened in January, but it was like, hey, it's nice for them not to feel like it's safe and secure so they can choose a life that they want. Like we're talking about someone that's in the FBI and loves it, that's a different thing than someone that goes and gets it because there's benefits and security. And that's why they go chase that job, because they'll never have either, because that's misinformation. The only benefits and security we have is our sole purpose, is our best abilities, is our own leadership in discovering what our values are, in adding value to the economy. And you know what? The reason why politics sucks more than anything is because of the complexity that we don't know what's going on to such a high degree. It's so removed from our daily actions that we get robbed, that we get and it gets frustrating. So rather than focus on it very often, I don't watch the news because I like my life. And, all I do is I sit there and think, what do I have control over to take a step in a direction to improve my circle of influence, to make a bigger impact, to actually enjoy life, not listening to a narrative that's a global economy that I have such little control over that people get stuck in complaining. People that get stuck in complaining that point out, like the people that I hate the conversations with the most is when all we do is point out the problems in the conversation. Like, there's plenty of problems everywhere, but I love when people have solutions and ideas and actions and something that's actually productive. So anyway, there's my soapbox.
I think that's a note to end on. That was really great.
Right.
Thank you, Garrett.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.